How can you become a millionaire with $100? Warren Buffett's net worth is an impressive $105.4 billion, with $105.1 billion of that amount accumulated after his 50th birthday and $102.4 billion earned after his mid-60s. His secret isn't just being a very good investor. His secret is time. There is an uncountable number of books that discuss how Warren Buffett amassed his wealth. Many of them are excellent. Very few of them acknowledge the most basic fact. Buffett's success is not solely attributed to being a skilled investor, but rather to the fact that he has been a skilled investor since childhood. Buffett's investment skills are exceptional, but imagine he was a more average investor. If Buffett had started investing in the stock market at 30, and his initial capital had been, say, $25,000, and let's assume that he still achieved the extraordinary annual returns of 22%, but had quit investing at the age of 60. If we were to estimate his net worth today, under these hypothetical conditions, it would be around $11.9 million, 99.9% less than his actual net worth. The illustrated example is given by Morgan Housel, mentioned in his book, The Psychology of Money. I will put a link to the video I created on his book in the video description. Now let's get back to the initial question. How does this benefit you? Basically, there are three factors to consider when building wealth: annual return, saving rate or better invested money, and most importantly, time. The S&P 500 has had an annual return of around 10% over the last 20 years, including dividends. If you had invested $100 20 years ago, they would be worth $672 today. That doesn't sound much at first, but when you consider that the original investment was only $100, that's an increase of almost 7 times. And that's where the fun begins. As we have already learned, the compound interest effect becomes powerful in the long run. After another 20 years, the original investment has already increased to over $4,500. And so it goes on with $30,000 and just over $240,000. Even if healthcare is improving rapidly, you probably don't want to wait 80 years. If you are like me, you may not be very patient and want faster results. But imagine 40 years from now when your future self has all the options in the world and spends his time as he pleases, instead of regretting ignoring the power of compound interest. You can also speed up this process, of course. Let's say you invest $100 every month. This would lead to around $22,000 after 10 years, over $200,000 after 30 years, and $1.5 million after 50 years. And the interesting thing is that only $61,200 of this is saved by yourself. The rest is taken care of by the compound interest effect. Let's look at this from a different angle. We assume an initial investment of $10,000, 10% annual return, and a time horizon of 50 years. This would result in a future value of just under $1.2 million. Let's now cut all the relevant factors in half and see how much we are missing out on. If we reduce the initial investment to $5,000, we would also be left with half the money in the future. A 5% annual return would result in a final amount of $115,000. The biggest impact is time. If we shorten the time horizon to 25 years, the final amount would be $1,065,000 less than originally. Even though the annual return and the investment horizon are close, the example shows the huge influence of time. It is also much easier to influence than the return, which itself depends on a countless number of factors. The smallest influence is exerted by the starting capital, which in turn shows that even smaller amounts have enormous potential. The example from the book continues as follows. Since 1988, Jim Simons, head of the hedge fund Renaissance Technologies, has achieved an astonishing annual return of 66%, a performance that no one else has even come close to. Despite Simons' impressive achievements, his current net worth is $28.1 billion, approximately 75% less than Buffett's. Simons didn't invest until he reached the age of 50, which means he's had less than half as many years as Buffett to compound his returns. If James Simons had been able to earn his 66% annual returns over the same period like Buffett, his net worth would exceed $63 quintillion, a shockingly high amount. This may surprise you, because the result does not seem correct nor logical. Linear thinking is much more intuitive than exponential thinking. The counterintuitive nature of compounding leads us to overlook its power. Therefore, we often tend to solve problems in other ways. Investing isn't necessarily about getting the highest returns, because those are usually one-off hits that won't last. It's about generating decent returns that can be maintained over time. This is when compound interest can work its magic. If you want to mess around with the numbers yourself, there is a link to a calculator in the video description. Also, if you liked the video, please consider subscribing.